Dhiraj Relli now joining us, and we want to sort of address the other big talking point, right? Which is the RBI circular which came through and the impact on stockbrokers. Dhiraj, good morning. Great to have you with us here on the program, bright and early. So there are a bunch of things, right? 5 or 6 things in the circular which came through. There is only 100% secured funding for brokers, bank guarantees, right? Where minimum 50% collateral required, and out of that 50%, 25% must be cash. No bank funding for prop trading. All exposure now counts as capital market exposure. And, there is overall collateral monitoring plus margin call provisions, etc. Which of these, let's take it one by one. And you tell us, which is the one which makes the most impact, Dhiraj, according to you, from a broker's perspective?
I think this circular is a bit tough on the prop traders, prop brokers, largely, but not much impact on the client-based brokers. This circular used term capital market intermediaries. I am using for your audience understanding stockbrokers. So basically, when it comes to providing the margins, brokers do reach out bank and they take funding from the bank in the form of bank guarantees, and they provide these bank guarantees to the clearing corporations. Nothing changes for the bank brokers who are taking these bank guarantees for the client trades. It only changes for the brokers who are taking these bank guarantees for prop business. That's where they now have to provide 100% collateral plus cash margin. So basically 50% has to be cash margin and 50% should come from the collateral, which is cash equivalent. That's something we need to see the definition clearly. What is cash equivalent? It can be cash and GSECs and with haircut equities as well. So what essentially this circular is doing, it's defining the collaterals very clearly. What are the collaterals you can take? What are the haircuts you can take? Some of these things were not clearly articulated. Earlier, there were no separate categories for the brokers who are taking bank guarantees for the purposes of placing margins with the clearing corporations. Now they have introduced a separate category. That's where the hit. And let me just remind all of you that prop brokers constitutes about 40% of the F&O volume, and more so in the option space. So that's where we see some kind of a setback. As far as capital market exposures are concerned, most of the banks are comfortable with the capital market exposure, so I don't see a significant challenge there. In fact, there have been some positives and some more clarity. Like if a brokerage house is looking forward to buy an office and they want to take a loan against that, that's easily allowed, business as usual for the banks also. On one more area where we have seen there is a setback, that is on the intraday limits. On intraday, some of the brokerage houses were taking higher exposure, and we know that the volatility gets created during the expiry days. That's where they were using these limits, and now they will not be able to use these limits because the cost of these limits will go up significantly, and they have to provide the full 100% on to avail these limits.
Yeah. So, okay, that's a lot of stuff to process, Dhiraj. But a few things, right? You're saying that it's the circular in totality is the hardest for the prop business, proprietary trading, right?
Yes, absolutely. No impact on bank guarantees for client trades. It was same 50% margin, 25% cash. It remains the same.
Okay. So for our viewers, prop trading basically is when you are trading with your own money for yourself, right? And
yes.
And you're saying prop trading would be about 40% of overall F&O volumes.
Yes.
Okay.
That is right.
Client-based for the margin that you post and collateral you post to exchanges when you are acting on behalf of the regular trading, which is our audience, etc. There is no change in that in those rules. What you have to post as collateral.
Yes. Margins remains the same. Margins have to be placed with the clearing corporation, not with the exchanges. So for placing the margin, brokers do take bank guarantees from the banks, and for client-related trades, there are no changes.
Right.
Brokers who have been taking these bank guarantees to place margins for the proprietary trade,
Yeah.
which is trade in their own books only with their own money. That's where they have to provide 100% collateral now, out of which 50% has to be cash and 50% has to be cash and equivalents.
Got that. Got that. Dhiraj, what you said that 40% F&O activity, right? So, like HDFC, just using as an example, I mean, all brokers would have this exposure to prop as well?
Hardly, large brokers will have a very small exposure into the prop, and they are not, using significant bank guarantees for the prop business. So most of the brokerage houses that are listed and those who are large brokers will not have impact. It's more to do with the prop brokers.
So, right. And these are when you say prop brokers, they're not your HDFCs and Angels and of the world. They're what? What kind of brokers are we talking about here?
These are all mom and pop shops. Some of the large players are also there who run their own books and they do transaction only with their own funds in their own books only. These are called prop brokers. They do not accept client money and they do not take exposure on the behalf of clients. So this is only for the prop books, and this is a very large component. It provides a liquidity to the market. It would mean that if the volumes come down, it would mean that we'll have a higher spreads and higher impact cost also. So it will have an impact on the derivative volumes for sure, as their cost of borrowings are increasing and it is becoming tougher for them to borrow. Hence, their activity will come down. Actually, if you look at it, the increase in the STT by the government, some actions by the SEBI in the past, and now this action in terms of providing absolute lister clarity on the collateral as well as on the haircuts. My take is that, the government is in synchronization trying to curb the speculative activities in the derivative space.
Do you expect an impact on the overall volumes now in the F&O space? Because there was already one hit which came through in the budget. Now this, do you see an increase in impact costs for the overall F&O volumes? What kind of an impact could we see?
On a ballpark estimate, I think 15 to 20% impact will be there on a volume effective April 1st, 2026.
Right. F&O volumes, right?
Yes, F&O volume. There is no problems with the cash transaction, cash segment, no issues at all. F&O, and within F&O, there will be higher impact on the intraday volume in the F&O.
Right.
And for you all in particular, what percentage of your overall volumes are prop, and of that, what percentage do you depend on for bank guarantees?
For us, the impact is absolutely zero.
Yeah.
And I can tell you, for most of the other brokerage houses, the impact will be negligible here. Very, very minimal impact. So it's largely to address the brokers who are transacting in their own prop book and not for the large brokers like Prashant has taken name. And these are not stock recommendations, but all Angel, ISEC, HDFC Securities, RBI, everyone including will have very minimal impact. They have very limited book. Motilal Oswal may have a little bit larger prop book, but I have not looked at what will be the impact on the same.
That's very helpful, Dhiraj, and absolutely not stock specific recommendations or anything, but just trying to get a sense. But for
I want to tell you that most of the brokerage houses actually borrow for MTF purposes from commercial paper. With this circular, there is some option now available with them to borrow from the banks. More clarity has to come, but that will open up a door, and that's a large overall exposure. More than 1 lakh crore is the outstanding exposure in the MTF market. So bank will get an opportunity to lend in MTF.
No, that is the other circular, Dhiraj. For the MTF, this is the same circular, or that's the other one?
Same circular. Earlier, banks were not lending for the margin trade facility purposes.
Correct.
Now they can lend for a margin trade facility purposes.
Right.
So to that extent, there are conditions, but that'll open up the market for the banks. And earlier it was not open, and brokers were only reaching out to the market participants for commercial papers.
Yeah.
In fact, there are clarity on the non-MTF book trade receivables also. Brokers can take funding from the banks on non-MTF trade receivables. Let's say a client owes you a money and you can borrow against that also from the bank. So it's a very detailed circular. It requires full slicing and dicing and understanding. It requires
Got it.
calibration actually.
Got it. Yeah, no, absolutely. Dhiraj, for listed brokers, largely, broadly I'm saying, negligible impact maybe for one or two names, perhaps slightly more than others, right? And this MTF thing we'll have to explore more, and I hope we can talk again. But I guess for exchanges, the impact is going to be there because, as you say, if the impact is 15 to 20% of F&O volumes, then exchange earnings perhaps are hit from the 1st of April. And of course,
Combination of all the factors together, like increase in the STT, measures taken by SEBI, and also now this
RBI circular. Yeah.
Yes.
Yeah. Thank you very much, Dhiraj. I really appreciate you coming in bright and early and clarifying those things for us. Very useful for our viewers. Appreciate it. Thank you. Let me just quickly run you through the interactions which are lined up here on the program. So 8:35.